Financial accounting, Chapter 9, long-term assets, both fixed assets and intangible assets. This is part 1 of 3. So in this section, one of the key sections to understanding the other two, we're going to learn about how we define, classify, and account for fixed assets, which will provide a similar idea for how we work with natural resources and intangible assets. So let me remind you, with this chapter, as with all chapters, we're talking about a new type of assets. We've talked about cash, we've talked about accounts receivable, we've talked about inventory. Now we're going to fixed assets. We're going to talk about how we account for them. So we're digging deeply into the financial statements as we cover assets one more time. So fixed assets are long-term, permanent assets. There's lots of terms for them. They're called plant assets or plant property and equipment. Sometimes they're called PP&E for plant property and equipment. As we've said, in case this is ringing a bell with something you've listened to before, we talked about this in the Adjusting Journal Entry chapter, Chapter 3. And we talked about what journal entry is required to allocate the cost of a fixed asset over its estimated life. So this is the chapter where we're going to go into more details about this process. So fixed assets exist physically and are considered to be tangible assets. By tangible, that means they have substance. They can be touched. We're not talking about a patent or a copyright, which is more of an agreement, but we're talking about a tangible asset such as a computer or a plant, like a factory. I think you could probably call Boeing in North Charleston to be a plant. Fixed assets are owned and used in the normal operations of the business. That means that they're being used. They're not sitting around waiting to be sold. That's inventory. And they're not sitting somewhere idle. That would maybe be an investment. So they're not offered by sale. And again, you should know what that is, an asset offered by sale. So a cost that's been incurred whenever a company spends money, there are 3 categories. And hopefully by now you're understanding the difference in these 3, but let's just look at this nice little chart that shows us how to categorize it. So you spend some money. It's a cost. So the first question is, do you anticipate that this purchase is going to be long-lived? And if the answer is no, it's an expense. If it's something that's going to be used in less than a year, it's going to be considered an expense immediately. But if you think it's going to last for longer than a year, then we'll go to step 2. And the question is it used in the normal operations of the business? And the answer is yes, then it's a fixed asset. If the answer is no, then it's possibly an investment. So that might be that a company buys a vacant building, knowing that down the road it will be a good investment to either sell to another company or possibly to expand. That's not a fixed asset, that's an investment. So this is a nice, quick, and simple process. And I'm going to throw in a higher level twist for you. Is the item purchased long term? And I would say for a garbage can or for a stapler, the answer is yes. And is it used in the normal operations? The answer again is yes. So we do have a cost-benefit rule of materiality, and probably not discussed in the text, but teaching advanced classes lets me know that I need to alert you to the fact that there's a level of materiality. A company is not going to take a $20 garbage can that they think will last 5 years and calculate depreciation on it. It's just not worth the time or effort. We're talking about large items, significant size, cost. I shouldn't say size, but cost. And those are our fixed assets that we'll be dealing with in this chapter. So as we account for depreciation, we're going to record these assets as an expense over their time that we anticipate them to be used. And this expense is going to be called depreciation. It has nothing to do with value. Recall that stern comment from Chapter 3. Recording depreciation which is the cost of a fixed asset, has nothing to do with value. It's just an estimate. And let me give you a big warning down here in red. Land is not depreciated. There are some exceptions we'll talk about later, but land is not depreciated. Once it's purchased, it stays on the books. So here's an interesting example. If a company buys a building for $1 million, they have to separate the cost of the building itself from the value of the land that the building is on. And that land is not depreciated, but the building itself will be. So let's talk about accounting for depreciation. First of all, depreciation does not measure the decline in the market value. Instead, it's the allocation of an asset's cost over its estimated useful life. Depreciation is the allocation. That means let's divide it out. Let's divide the asset's cost over its estimated useful life. If we pay $10,000 for a truck, and we think that truck is going to last 5 years, and then we're going to throw it in the dump, then it's $2,000 a year, 10,000 divided by 5. Depreciation is allocating an asset's cost over its estimated useful life. And again, memorize this definition. You will see it again. Okay, when we're calculating depreciation, there are 3 things that we need to consider to be able to do the calculation. One of them is how much did we have to pay for this asset? The second one is how long do we think it's going to last? And the third one is how much do we think it's going to be worth at the end? So we'll go over each of these separately. Number 1, the initial cost of an asset is what we paid for it plus any additional expenditures that it takes for us to get it in place and usable. And that might be freight or installation, and the book goes through an extremely long list that I'm not that attentive to on an exam. You will possibly see that on your homework. The expected useful life, generally it has to do with years. Sometimes it can be service. You expect a copy machine to make 1 million copies. You expect a truck to drive a certain number of miles. You expect a machine to run a certain number of hours. So that's what we talk about when we talk about the expected useful life of a fixed asset. Finally, the residual value, and that is also known as scrap or salvage value or trade-in value. So it's just common sense that generally a business won't drive a truck for 5 years and then throw it away because it was expected to last 5 years. They will sell it for scrap, or they'll have a residual value, or they'll have a trade-in value. And so that's one of the factors used as we determine depreciation expense. So one of the things that you have to do is memorize a lot of formulas when you're doing depreciation expense. If you take the cost of an asset and you subtract out its residual value, that's going to tell you how much you're going to depreciate. So here's another formula to memorize. Cost, whatever you paid for it, minus the estimated residual value, again, an estimate, and that's equal to the cost that you're going to depreciate. Cost is actually known. How much money did you pay for this asset? Residual value, salvage value is an estimate. And then we'll take this depreciable cost and we'll allocate it or divide it out over the number of years or the number of useful units of production that we think it's going to last. And the theory is that when we're finished and whenever we're done with it, the residual value is what's left over. Of course, this is an estimate, but it's an important estimate that's made in financial accounting. This is a formula you memorized in Chapter 3, and that is that depreciation expense is recorded with an adjusting entry. And I hope you remember the DEAD, because here it is again. The debit is to depreciation expense. It's an expense recorded on the accounting records for the allocation of the asset's cost, and accumulated depreciation is a contra asset. So since the value of the asset has not declined, but instead we're doing an estimate, then we'd use a contra asset called accumulated depreciation. This is exactly the same as the contra asset allowance for uncollectible accounts, because that's an estimate. We don't want users of the financial statements to think our asset has gone down in value. For the most part, it has declined in value, but it just depends. So we record accumulated depreciation as a contra asset, and it will be netted against the asset to find out what the net book value is of the asset's cost. So depreciation is recorded at the end of the accounting period by this adjusting entry, that it helps if you kind of memorize the formula, the D, E, and the A, D. So let's take an example of Exeter Company, and we've got the information we need. They paid $24,000. The asset's going to last for 5 years, and the estimated residual value is $2,000. So the cost is actual. The useful life is estimated. The residual value is estimated. These estimates are going to come from the accounting department, possibly in conjunction with management, possibly with a policy for the firm over the expected useful life and residual value of specific types of assets. In this example, we have a forklift. So with this forklift, what we have is a $24,000 cost, and we have a $2,000 estimated residual value. So we're going to depreciate this $22,000 over the life of 5 years, useful life of 5 years. So the thought is that in the first year, we paid $24,000. It would be inaccurate to record that $24,000 as an expense, because that would be too large of an expense for year one, when that expense actually applies to 5 years, when they actually bought this forklift to last for 5 years and then to anticipate a residual value of $2,000 at the end of 5 years. Additionally, if we look at generally accepted accounting principles, we will find that we've understated assets if we don't record this as an asset, and we've overstated expenses. So therefore, GAAP requires that a fixed asset that has an estimated useful life of greater than a year must be recorded as an asset, and then over the next years, the estimated life, we will show that this asset has declined piece by piece. Again, we're going to be using accumulated depreciation as a... Finally, in this first part, let's talk about the 3 depreciation methods that we're going to be using. One of them we're not going to cover. Notice I've marked through it. But there are 3 depreciation methods frequently used. One of them is straight line. That makes sense. Just to evenly calculate over 5-year life or 10-year life or whatever. And we'll talk about that in part 2. The other one that we'll be discussing is the units of activity. And it's frequently used. If you're an engineer, you know that the units of activity is used in a factory. For example, how much did this piece of equipment cost and how many hours do we think it's going to run? And you record depreciation based on the hours that the equipment has used. Alternately, it may be the number of miles that a vehicle drives, or it may be the number of copy machines, the number of copies that a copy machine is using. But these are the 3 most frequently used depreciation methods. Double declining balance is discussed in the text, but we will not be covering it in this course. Instead, if you're an accounting major, you will be covering it in your upper level intermediate class. So we're going to move on in part 2 of 3 to talk about how to calculate these 2 depreciation methods, and also what to do if your asset is sold.